there's two different ways that you want to view life insurance. One is through the lens of pure protection, meaning I am trying to protect against loss of income, protect against paying off debt, things of that nature. When you view life insurance through the lens of protection only, it's an expense, no different than any other insurance, and you want to buy the most death benefit you can for the least amount of money you can get away with. And that's where term insurance really becomes to, I would say, be the primary solution for that particular need, because protection is the most important thing, and I can get the most amount of protection for the least amount of money using term insurance. Whereas if you start to flip that lens, and maybe we're looking at insurance for estate taxes, because I have a net worth that is high enough that the government's going to tax it at 40% over and above the exemption. I don't want that money to go to the government. I want it to go to the family, or I certainly want my estate to be reimbursed, if you will, or have the cash, the liquidity to pay estate taxes. When you start dealing with that and the certainty of death, then permanent insurance becomes certainly the solution, because I don't know when I'm going to die. I know I'm going to die, but I need a policy that's going to be around. You also can view insurance, and we do, as an asset class, permanent insurance as an asset class. And this is where we want to take advantage of the cash value and the inherent aspects inside life insurance, cash value inside it, where the death benefit is really secondary. It's the cash value that's the primary point, and that's because it's very predictable in growth. It grows tax deferred, similar to like an IRA, only I have accessibility of it today. I don't have to wait till I'm 59 and a half. There's even some liquidity advantages to it. And so all of that now becomes an asset class. And in that case, when death benefit's secondary, I actually want to secure the death benefit down to the least amount that I have to secure, that I have to buy for the most money that I can contribute, because I don't want the insurance costs to eat into the growth and the value. When you view it through that lens, the only way to do that is through permanent policy. So there are lots of different types of permanent policies. And just like anything, not all things are created equal. So there's whole life. That's typically where you've got just a standard interest rate, and the growth in that is paid by the company, typically return of profit. It's dividend whole life or participating whole life. All of the growth and the way that those policies grows, they've got a guaranteed interest rate, and then the company declares dividends. And as a mutual company, the policyholder is an owner of the insurance company. So you therefore get a percentage of the profits. That's in the form of dividend. You have universal life. Universal life has a crediting rate associated with it. The insurance company declares, typically they've got a guaranteed and a current rate. So they got a guarantee that's much lower, that's in the policy, and then they got a current rate that gets declared every single solitary year. All different life policies have different aspects to it. Philosophically at Prevail, when we want to use it as an asset class, we want it to be an alternative asset class. We don't want it to mirror something else. So anytime you're looking at index products or variable products where the growth, the reward, and thus the risk is affiliated with the stock market or some form of it, now it's mirroring another asset class. That's why we love participating whole life, because again, the insurance company and the profitability of the insurance company is driving the return, not the market.